What's up, traders? I'm Mark Bauman, owner of StartTrading.com, and today we are talking about leverage in the Forex market. But before we get started, please leave this video a nice thumbs up, and if you haven't already, hit that red subscribe button below. From what you've seen so far in the course, you must be wondering how on earth do people manage to make a considerable income trading Forex when the values of each pip are so small, especially when we use proper risk management. So if you don't remember what a pip is, make sure you go check out one of our previous videos in our Forex Fundamentals series for a more in-depth explanation. In simple terms, a pip stands for percentage in point of price, interest point, and in the point of change of the rate of a pair. Now, leverage it's what amounts of substantially higher than the amount you already have in your trading account by using your account balance as margin. So leverage is expressed as a ratio and is used to show the amount of money you have in your account and how much money you can actually trade. For example, imagine you have $40,000 and you want to buy a property that costs you $200,000. Now the bank offers you the mortgage as long as you make a 20% down payment for the property value up front, which means that you are paying $40,000 in advance and the bank will loan you the remaining $160,000. In the example, you have the property has a leverage of 5-to-1. Now there are several benefits to leverage. You can get a higher exposure to the market, which in turn allows you to profit at a much higher rate when your trade wins. And then there's low margin requirements, and that's interest-free, so you could be considered a short-term interest-free loan. There are also some risks that come with the practice, as well as having a higher exposure to the market, and it is a double-edged sword. If we can get access to higher profits, which also means that we have access to higher significant losses, and when trading at a higher leverage, then you can look into something like a margin call, which occurs when the value of your margin falls below what the broker's threshold is, and this gives the broker the right to immediately liquidate all your portfolio as well as any current assets, effectively wiping out your account. So margin call can easily be avoided if you always trade sensibly with your stocks and Forex, as well as do an optional risk strategy. Now remember, there's no magic to what you're doing to make massive profits. Merely position your size and subsequent trades. Make sure you make more wins than losses, and be safe with your margin. That's all I can say. So that's going to about do it for me. Thank you for watching as well. As always, at StartTrading.com, make sure you go there and take our free course. And as always, make sure you hit the like button or the subscribe button. Thanks, I'm Mark Bauman.